Live from NBC4, this is the Channel 4 News at 11.
Now to the economy. It is already Tuesday overseas, and Japanese markets have fallen to a 25-year low following today's steep dive on Wall Street. The Dow Jones today lost 300 points to close under 6,800. It is the lowest close since 1997. NASDAQ and S&P also lost ground. The sell-off came after insurance giant AIG posted the biggest loss in U.S. history. There was, however, a little good news today. Consumer spending edged up just a little bit last month, and the personal savings rate, how much you save of your income, rose to 5%, which is actually a 14-year high. So what should you be doing with your money right now? NBC4's Patrick Healy live with some of the answers for us. Patrick.
Colleen, well, of course, with hindsight, the problems like AIG are all apparent. If only the future were so clear. So take a listen to three financial planners who have some suggestions and some warnings.
Monies that are going to be needed in the next 1, 2, 3 years probably ought to not be in the stock market.
If they're still in, they've got to do something. If they're out, I would just hold tight.
If you were to sell out today, you're going to guarantee yourself a market loss.
Meet Scott Leonard of Trovena, Phil Gainsborough of Gainsborough Financial Consultants, and Michael Hatch of the Sterling Group, all certified financial planners, all in the pressure cooker of advising people what to do with savings eroding in the midst of ongoing financial crisis and economic decline.
If you don't lose in this market, you're actually ahead.
Gainsborough and Hatch don't suggest putting your money in your mattress, but they do stress settling for the low returns of safe investments, such as treasury bills and federally insured bank accounts.
If you're seeing investment return that's got anything more than a 2 or 3% annual return these days, and it's quoted as safe, you probably ought to be looking at the fine print.
The biggest mistake is just to be reactionary to this market. Do ad hoc market timing. Go to cash with no plan on when you're going to get back in.
The worst thing that we think investors could do is chase returns, trying to recover in a hurry.
Specializing in higher net worth clients, Gainsborough has been using hedges.
And they go up when the market goes down, and we've used those for the last 3 to 6 months to protect capital.
And usually the way you would offset a hedge, the cost of a hedge, is you would cap your upside.
What all agree is that these are trying times for savers and planners alike. The toughest part?
Managing clients' expectation and their fear.
It's just that unknown. When is this going to be over? Just stop the torture, stop the pain, and let me start recovering from this. And we just don't know when that's going to happen.
They're very worried that this time it is different and we're not going to recover for a very, very long time.
So while the experts debate whether the buy and hold strategy is dead, chew on this. If you paid $10,000 today for a 3-month T-bill, your return will be $7.08 on 10 grand. But that's better than a loss. Live in Woodland Hills, Patrick Healy, Channel 4 News.